A very warm welcome. I'm your host and the moderator for today. My name is Prabhudev. We will start the session in a few minutes to allow everyone to join. Hello and welcome again. Welcome to all our participants. My name is Prabhudev. I represent the presence of ASK in the rest of Maharashtra region. Today, we will be doing the webinar on the ASK India Select portfolio. With me, I have Mr. Chetan Thacker, who is the portfolio manager for the India Select strategy. To introduce Chetan, Chetan has been with us for more than 8 years and has specialities in the sectors of chemicals, mining, and metals. In the event of the last few months, we've seen a good recovery in the India Select portfolio. On the back of a decent track record, I will open the session for Chetan to take it forward. Chetan, over to you.
Yeah, thank you so much, Prabhu. And thank you everyone for joining us this evening for this quarterly update call for the India Select portfolio. The way it is structured is I'll briefly cover the update during the quarter, what are the changes that have happened, covering the earnings profile of the portfolio, and we can then open the floor for question and answer. So to begin with, starting with the market outlook and outlook in general from a macro point of view, what we witnessed in the last 3 months is some abatement in inflation globally. We've seen this happen in US. We've seen some degree of this happen in the European countries as well. Inflation has been a key concern for quite some time now, because of which we have seen rapid rate increases. Cost of capital globally has gone up in a fight against inflation. What we are witnessing now is while inflation starts to tick down, it is still off from where the Federal Reserve would ideally want inflation to be from a longer term point of view. And hence, while rate hike cycles continue, the extent or quantum of rate hike has been reducing. We've seen a 25 pip rate hike last time around. The view is that as inflation gets under control, we will probably be in a situation where the quantum of rate increases will reduce. They should ideally plateau off at some stage as inflation settles at a lower level, and post which we will start to see probably some degree of moderation as far as the global cost of capital and interest rates are concerned. As far as the domestic picture is concerned, we've actually seen a faster deceleration in inflation. It appears as of now that the inflation has peaked out in the country. Our inflation, like we've been highlighting for quite some time now, has been more a function of imported inflation, largely coming in from the imports and crude basket in particular. So what we are witnessing is as those prices have cooled off a bit, we are actually starting to see inflation coming off. We've seen the RBI adopt a pause as far as the last monetary policy meet is concerned. The future outlook on the domestic cost of capital will hence be determined on data inflow that comes through. So far, the ticks that have come on inflation in the near term have been encouraging, and we are inching closer to that 4.5, 4.6% mark as far as CPI is concerned. And it is somewhere within the band where the RBI would like it, which is 4 to 6 plus minus 2% on the 4% range. We've seen commodity prices also coming off. A large reason for that has been the fact that global growth has started to slow down. What we witnessed is as we began this year, China was opening up. There was an anticipation that as China opens up after the COVID lockdown, you will essentially see demand bounce back in China. What we witnessed in the last 6 months, on the contrary, is that the demand bounce back in China was lower than what people would have penciled in. To that extent, we've started to see commodities also come off because demand has not been as buoyant as was anticipated when we were sitting in the month of January and February. So here in this chart, you can clearly see crude, which is one of a key monitorable for us because energy price is a key driver for inflation for us. We've actually seen crude prices come down and they are hovering around the $70 mark. If you look at how the global supply chains have behaved, I think this chart clearly depicts what is happening on the global supply bottleneck. This was another factor which was driving inflation for a large part of the entire COVID period. What we've started to witness is that there is moderation now, especially on freight costs. This is driven by two factors. One obviously is the fact that supply bottlenecks have started to ease off as the entire world has moved to normalcy post-COVID. We are starting to see zero COVID policy of China also being rolled back. That essentially means supply in general has started to improve. Freight costs have also reflected that, and we are starting to see freight cost also normalize, which points towards normalization in supply chain. This is a good sign because this points towards a gradual downward trajectory in inflation, and as supply chain bottlenecks continue to normalize, the expectation is supply bottleneck-led inflation will start to come under control. Agri prices, while they continue to remain elevated, it's down from the peak. Agri prices will have also a factor of weather. Weather has been obviously under pressure given the climatic conditions and changes that we are witnessing. Coming to flows, which is another important fact. The whole of last year was largely about large outflows from India, as you can witness from the column in this particular chart. In the last 3 months, particularly March, April, and May, we started to see positive flows from the FIIs. That has also provided a fillip to the market and has been a factor which has been driving the markets as well, as flows have started to improve and outflows have started to abate. The first tick of that started somewhere around February. I think that has continued to gain traction and momentum. May has actually seen a large inflow as far as our markets are concerned. As far as domestic participation is concerned, I think that participation structurally has gone up. SIPs continue to remain stable in the marketplace, and we continue to see SIPs supporting the market and domestic flows. Coming to the India Select portfolio in general, what we witnessed is the Q4 earnings season has just passed by. We have the earnings for FY23 as a whole. For Q4, there are 2 or 3 key trends that stand out. As anticipated by us, it was a quarter where, while volume growth was tepid, the earnings growth was largely driven by normalization in profit margins. That has played out across sectors, and what we witnessed at a portfolio level is that the operating profit growth for India Select stood at 24% in Q4, while sales growth was still tepid at 10%. If we extrapolate this going forward into how we see FY24 and 25, FY23, the year gone by, was essentially a year where there were 2 things that happened. One was while we saw volumes not picking up as anticipated when we started FY23, the first half was a half where we saw a lot of margin pressure across the board because of volatility in commodity prices, the fact that all those costs could not be passed on to the end consumers given weak demand. We started to see margin pressures start to abate from Q3. That trend has continued in Q4. As we look forward into FY24 and 25, the earnings growth is largely a function of margin expansion and normalization, which should continue. We have a very benign base of the first half of FY23, which will play out in FY24. On the volumes front, we are keeping a close eye there. Volumes in Q4 so far have still been tepid. So hence, the volume recovery is a factor that we are watching very closely. So there are two drivers to the volume recovery. One that we believe is more driven by government capex. We've actually seen capex outlay increase in the budget. We are starting to see implication and impact of that. If we look at high frequency numbers, be it steel consumption, cement consumption, which is in double digit, all of that points towards government capex going on full stream, and that is a factor that should drive volume recovery as we move into FY24. The second aspect is more driven by what will happen to the monsoons. While there is a prediction that the monsoon will be a tad bit below normal, we will see how that unfolds as we move forward. So we will still have a benign base as far as margins are concerned, and hence we believe that FY24 operating profit growth will be 21% for the portfolio as a whole, which compares with a nifty OP growth of 16%. As we roll forward into FY25, our sense is volume growth plus normalized margins will drive earnings both in 24 and 25, and operating profit growth for 25 also looks like 19%. If you look at where the Nifty valuations are, Nifty valuations were obviously depressed to some degree in the first quarter. They've just started to bounce back, and we started to see some degree of inch up that has happened as far as the Nifty valuations are concerned. We expect earnings trajectory for Nifty also to remain strong at 15% CAGR. This will be driven by both volume growth as well as margin expansion in sectors which were witnessing margin pressures. Plus the fact that financials have come around the corner and they should also start to contribute positively as far as the earnings growth are concerned. They were a large factor in FY23. We believe they'll continue to do that in FY24 and 25. Coming to the India Select portfolio, the way it is positioned at this point of time, since we last spoke, a key change has happened in the financial weightage in the portfolio. The weight has gone up. It is a function of both how the stock prices have behaved, plus the fact that we've added certain weights into the financial pocket. This was one pocket which we highlighted last time around, where we believe there is hope for weights to go up. We continue to firmly believe that financials is placed right as far as the growth is concerned. We expect loan growth to remain strong as we move into 24 and 25, driven by economic activity. We will also see a tailwind that we continue for a quarter or two as far as the credit cost and NIM expansion is concerned. From a more longer term to medium term point of view, the focus will obviously clearly shift back into the triangular of the growth metric, asset quality, as far as the financial space is concerned. Our expectation is financials will continue to deliver strong earnings growth going forward from a more medium to long term point of view as well. Consumption is another pocket where we were overweight. We continue to remain overweight. Our belief is that discretionary spend, which was witnessing a headwind both in terms of volumes remaining tepid and margins remaining under pressure, that has turned the corner as far as margins are concerned. A volume is something that we'll watch very closely as we move forward. Our belief is that volumes first will get a fillip as far as the domestic side is concerned from the government capex that is rolling off in this current year. That should get built onto as we see how the monsoons progress, and that should start to reflect in recovery on the rural balance sheet. Rural has been a pain point as far as fourth quarter was concerned. It is quite evident from the commentary of managements that rural still continues to remain under pressure. The expectation is both driven by capex and support from the monsoon front. We start to see some degree of volume recovery that happens on rural, while urban continues on the volume recovery path that it has been witnessing for quite some time. A pocket where we remain underweight is the technology pack. We continue to remain underweight on the software side. That has been one pocket which has disappointed as far as Q4 numbers were concerned. We've essentially seen numbers miss what we were expecting on the software front. Our belief there is while valuations are supportive, while structurally from a more medium to long term perspective, digitization is a theme that will play out. We are essentially seeing some degree of headwinds that is happening as far as that space is concerned. In general, as far as exports are concerned, last year was a period where we witnessed a lot of destocking across a lot of sectors as the globe adjusted to both the effect of increase in cost of capital and the fact that demand itself was more tepid than what was anticipated. Plus, it obviously has a bearing on how cost of capital behaves. We witnessed a large degree of destocking across a lot of pockets as far as exports are concerned. Our belief here is, and based on the commentaries from the management, is that probably we are still a quarter or two away from the restocking cycle. So that will be a first leg which drives export growth. The first batch of recovery will begin from restocking because we've seen inventory levels run down across a lot of industries. As the risk of inflation starts to abate, as we start to see more normalization in demand, our belief is exports will start to contribute towards growth going forward from a more medium to long-term perspective. If we just zoom out a bit and look at exports, I think India now is firmly on the map as far as manufacturing is concerned. That is one sector where India lagged as far as its peers in the Asian world are concerned. We've seen a conscious government policy push as far as exports are concerned by way of PLI schemes, by way of a lower corporate tax rate for setting up new entities. Our belief is that manufacturing in general will get a fillip as we move from a more medium to long-term perspective. It will be both a function of companies looking and countries looking at India as an alternate destination for setting up manufacturing entities, plus the fact that there is a vast opportunity which is still available from import substitution, and that will also continue to happen. The period of PLI of 5 years is essentially a handholding period in our assessment, which provides firms with fair degree of time to build economies of scale and remain competitive and become more competitive as far as global manufacturing is concerned. So on exports, we really believe that the first leg of restocking will start to revive growth there, followed by a strong structural tailwind of India emerging as an alternate destination as far as manufacturing is concerned. Chemicals is another pocket where we are overweight. That fits into our theme that we've been highlighting for some time, that we believe that this is one sector where India has an opportunity to scale up globally. We've started to see, as far as numbers are concerned, delivery of contracts, long-term contracts for a lot of entities. Inquiries continue to remain strong. Our expectation is that this is one pocket. If you look at the overall larger scheme of things, we are still $200 billion as far as the industry size is concerned, while China would be similar in exports and $1 trillion as far as the China chemical space itself is concerned. So even if we are able to capture a higher share of the incremental global growth of 2 to 3%, that still means at a sector level, we can see 11 to 12% kind of growth that can happen. Companies which are right placed in this particular pocket should be able to capture this opportunity better, and in turn growing at a much faster clip compared to the industry growth that is there. Automobiles is one pocket where we continue to remain underweight. We are evaluating to see if we can get more names into that pocket, and we are watching that space very closely, because that space is fraught with some degree of technology disruption that is happening as we move towards electric vehicles and move away from ICE engines. So this is how the portfolio is positioned at this point of time. We remain, in summary, overweight on financials. We remain overweight on consumption. We remain overweight on chemicals / manufacturing. As far as the psychography of the portfolio is concerned, the EPS growth for 24 is closer to 20%, 25 is 21%. The ROCs are significantly higher than the benchmark ROCs at 29 and 31%. What we witnessed in this period is also compression on the PE for the portfolio as a whole, because FY23, while we ended the year with growth of 18-19% on operating profit, we essentially witnessed the portfolio not moving too much, which meant that the portfolio became more attractive from a valuation point of view, as the underlying growth in earnings continued to remain strong. And that is a reflection as far as the portfolio valuation itself are concerned. So our view is that the valuations have become more reasonable because earnings delivery continues to remain strong, while stock prices did not adequately reflect the delivery in earnings in FY23 as a whole. We've started to see early signs of revival as far as the first quarter are concerned. Our belief is if our portfolios continue to deliver what we expect from them in earnings growth, I think returns will obviously be a function of how earnings growth behaves for the portfolio. This is a snapshot of the long-term picture of the ASK India Select portfolio. We've essentially seen PBT growth of 17%, PAT growth similarly of 17%, ROC has been 31%. With a profile which has a higher ROC for the portfolio as a whole compared to where the benchmark is, we believe if earnings growth remains strong as we anticipate, that should find reflection as far as performance of the portfolio going forward is concerned. This is a brief snapshot of the performance in various timescales. What you witness in the right corner is the performance in FY24 YTD. There has been some early signs of improvement. Our belief is if earnings growth continue in the trajectory that we anticipate, we should be able to catch up on the lost ground of FY23. That's it as far as the presentation is concerned. We'll now open the floor for questions.
Thanks, Chetan. That was insightful. Participants, we have a question and answer box wherein you can type in and send us your questions. We will consolidate them and try to address them. Chetan, in the meantime, we have a set of questions that we can take immediately. At ASK, we're known to focus on a high growth, high quality kind of a portfolio. In that context, how is the valuation of the overall portfolio placed? Considering that just a year ago, most of the stocks were at premium or very high valuations.
So, Prabhu, like I have highlighted in the presentation itself, what we witnessed was FY23 saw the earnings growth remain in the range of 18-19%, while the portfolio underperformed. So that has meant that valuations have to some degree corrected in this period. Valuations, like we touched upon in the presentation itself, they are probably closer to 22-23 times forward. Our sense is that if earnings delivery continues to remain strong, that will find a reflection as far as performance of the portfolio overall is concerned and stocks within it is concerned. So valuations from a historical point of view, I think FY23 was a year where underlying earnings growth happened, while the portfolio corrected, which meant that valuations to some degree have also corrected. If we look at this same portfolio, look at this same approach from a more medium to long-term perspective, our belief is that valuations are a function essentially of two very critical things. One is the earnings profile of the portfolio or a stock in general, and the second is the quality of that earnings. So we continue to stick to our philosophy of high quality, high growth. There are obviously times in the marketplace where styles keep changing. We are wedded to a particular style, and our belief is that this style has the ingredients to deliver returns from a more longer term perspective. While earnings growth per se obviously adds to returns, it's essentially the quality of earnings that adds that extra bit to return from a more medium to long term perspective. What quality also ensures to do is that in periods of a volatile macro environment, which we witnessed in FY23, even in that environment, you get an outcome which is something similar to what we've seen not only in FY23 but also in FY21 when COVID was at its peak. Despite a COVID lockdown, what we witnessed was a 16% earnings growth for the portfolio. That over a period of time, our senses gets valued, and that adds extra bit to the return over and above what can be delivered from earnings.
Thanks, Chetan. So we have the first question from one of our participants today. Abhishek Arjun is asking, insurance sectors has suffered a few headwinds in recent past. What would be the expectations going forward, and are we looking at adding exposure in this sector?
So Arjun, thanks for the question. We essentially have HDFC Life in the portfolio as far as the insurance space exposure is concerned, and a Bajaj Finserv, which has both the general and the life insurance business. What has happened particularly, so I'll just break this into two. One is the general insurance piece. On general insurance piece, we have seen some degree of higher competitive intensity as far as the motor piece is concerned within the general insurance space. While health has been very clearly a focus area for most of the general insurers, health is one space where we believe that growth will continue to remain high for a longer period of time. The country continues to be underinsured as far as health insurance is concerned. There is scope both of penetration, there is scope both of the sum assured itself going up, which means that health will over a period of time become the largest part as far as the general insurance is concerned. So we've seen a fair degree of push from all players as far as health is concerned. The way health operates is you have two bifurcations, group and retail. Most of the insurance companies are playing on both these pockets to develop both these businesses from a more medium to long-term perspective. Motor is one business where we've seen fair degree of competitive intensity, which has meant that combined ratios for motor itself were higher at an industry level as well. Our belief is that we have started to see some degree of abatement of that competitive intensity. We started to see some degree of price increases. As far as motor is concerned, motor is a profitable business. So our sense is while motor will come off this competitive intensity period, you will essentially see positive contribution from both health and the motor side as we move into more medium to long term perspective. As far as life is concerned, life has essentially seen a tweak in the way it was taxed and how taxation was dealt with on life, particularly on the guaranteed non-par products, which was something like an HDFC Sanchay Plus. So on the non-par guaranteed product, there has been a tax implication. That means that obviously most of these health insurance companies or life insurance companies will tweak the way they approach this particular space. The key monitorable as far as life insurance is concerned will be, are these entities strong enough to come up with product proposition which meet consumer requirement. So consumer requirement from an insurance point of view is largely two. One is protection, which still continues to remain underpenetrated. There is a large opportunity still on the protection side, which does not get impacted by what has happened on the taxation front. The second is more of a function of viewing insurance as more retirement planning / savings product. There our belief is that the nimbleness of the sector and the space and the ability to come up with products which meet both these criteria and requirements will drive growth from a more medium to long term perspective. There is an underpenetration as far as annuity products are concerned. There is an underpenetration as far as the pension itself is concerned, because at a country level, particularly on the private side, which is not on the public side, it's still a function of pensions being more individual. And this will play out from a more medium to long term perspective, as there is a clear need in the market space for annuity and pension products. And that is something which these insurance companies will plug the loophole and get into. Our view overall is, while FY24, from a base perspective, you might see some degree of moderation as far as AP is concerned, because a lot of rejigging will happen on the non-guaranteed, on the guaranteed non-par product. Our belief is there are positive levers as well on the both protection as well as the annuity side, which should support VNB margins. From a more longer term perspective, we still believe that there is an opportunity for this space to grow at 10-11% for leading players as far as AP is concerned, with some degree of upward movement on the VNB, or where they are, they continue to remain there. So we believe there is an attraction, while near term there can be some degree of volatility as far as AP is concerned, as they rejig to the changed taxation environment.
Thanks, Chetan. The next question we have in line is on the portfolio allocation to sectors. Which are the top sectors that India Select has focused on, and what is the direction ahead for those sectors in the near term?
So like I covered in my opening remark, so pockets where we are overweight is essentially financials, consumptions, manufacturing / chemicals. These are pockets where we believe there is a long-term opportunity. They fit into our philosophy of size of opportunity, long-term compounding of earnings. Within financials, we focus more closely on the retail bit of financing, as that book is more granular in nature. What we witnessed in FY23 is the fact that banks have essentially seen a fair degree of normalization of ROEs. We've actually seen ROEs expand, which was a function of obviously NIM expansion because of what was happening on the rate hike side, plus the fact that credit costs were significantly lower. So that meant that there was faster normalization as far as ROE is concerned. Going forward, our view is there is a large untapped opportunity as far as retail financing itself is concerned. Plus an added lever of, if economic activity starts to inch up, which we are witnessing early signs of, financials is obviously a contributor to that, and it is an enabler as far as economic growth is concerned. So loan growth will continue to remain strong, while we remain focused more on the retail bit of that particular opportunity, and even evaluate companies and names which fit our bill. We've actually increased weight on the financial sector itself. We've added 2 names during this quarter. We've added an SBI and an HDFC Limited into the portfolio. We believe earnings trajectory is upwards of 20% as far as financials are concerned. Coming to consumption, consumption is obviously a factor of structurally where India is poised and placed. We believe that as per capita income goes up, you will start to see consumption picking up. Given where we are, we'll probably see discretionary kind of consumption pick up more, because that is a pocket which benefits whenever we see sharp increase in per capita income. So that is a space where we believe there will be an acceleration as far as growth and earnings growth is concerned. So we are overweight on that particular pocket as well. Chemicals essentially fits into where we see manufacturing in general, which is also there in the portfolio / chemicals, which is more from a point of view that India is being largely now viewed as a space which can develop as an alternative to China as far as manufacturing is concerned. We are obviously seeing some degree of shifts happen. Our view there is you will not see base businesses shift out of China, but very clearly there will be incremental business which will start to move incrementally away from China, where India is well poised. There are certain pockets where we have inherent strength. That strength essentially comes from the available manpower in the pool that is available in the country. Chemicals / pharmaceuticals is a case in point there. There is obviously an opportunity that is opening up as supply chains start to be more inward looking, where there is scope of import substitution that will also play out. It will happen not only in these sectors, it will also happen across different sectors. That is also a driving factor as far as both manufacturing of electronics within the country is concerned. We've seen that happen in mobile phones. We are seeing that rapidly happen in other consumer durables and electronics. What will happen as we move forward is a lot of incremental parts which are still imported, they will get localized. We will see local manufacturing getting a boost. So manufacturing in general will be driven by two factors. One is ability to substitute imports, and the fact that India can still emerge as an export destination as people move supply chains away from China and want to reduce that gap. So that is another pocket where we are largely overweight. So these are the three large overweights within the portfolio.
So on those lines, a follow-up question on HDFC Limited. So expectation that the merger between HDFC Limited and HDFC Bank will create an entity which will not only be one of the biggest in the country, but in the world. What is the kind of opportunity we see in the merger, and what are the essential points thereafter after the merger for the new entity?
So the merger essentially helps HDFC Bank by increasing the duration of the book. HDFC Bank had a limited mortgage book as compared to the other listed peers and the other peers within the banking space. What this essentially does, it gets mortgages into the bank. That means the duration of the book itself increases, one. Second is with HDFC Bank and Limited merger happening, HDFC Limited products will now be available across 5,000-6,000 branches of HDFC Bank. That means the penetration of mortgages from an HDFC Bank perspective also significantly improves with this merger going through. So you not only have an elongation of the duration of the book itself, what you will also have is an opportunity for HDFC Bank Limited's product to be sold through HDFC Bank in a vaster channel and distribution network. The way we are essentially seeing the merger internally is that as the merger goes through, there is obviously a cost that happens because of SLR and CRR. Borrowings will get substituted from a more medium to long-term perspective by deposits. That is when the benefit of cost of deposits will also play through. In the very short term, you will see some degree of compression in ROE as SLR and CRR requirements are met. So there will be compression in ROE, while that will be scaled back to where we essentially witnessed where HDFC Bank can be in terms of ROE. A third aspect is very clearly the way the subsidiaries are dealt with. I think the fact that HDFC Bank will have a higher weight in HDFC Life, that in turn will mean that those products can also be pushed at a faster rate, and there is a higher degree of cross-selling that can happen now from the HDFC channel itself. So that increases the ability to cross-sell most of the subsidiary products as well through the bank. So it will now be very comparable to the other peer set. We've essentially seen strong underwriting capabilities of HDFC Bank over a period of time through the cycles that the country has been through. So it's an advantageous situation where you have those strong underwriting capabilities plus a distribution push, and the fact that the duration of the book becomes longer. So it will essentially be able to drive faster growth from a more longer term perspective while increasing the duration and stability of the book.
Thanks, Chetan. Next question is a combination of a few questions, in fact, pertaining to the performance of the India Select portfolio. In the past, over a medium to long term, there has been uh, performance such that post COVID, the strategy has lagged a bit. In the context, what are the actions we are taking? What are the steps that we are taking to make up the lost ground? And comparatively to other ASK strategies, how do we see India Select panning out in the near future?
So coming to the first aspect, which was the volatility in the performance of India Select itself, I think a fair degree of that was driven by the fact that we went some degree more conservative on the portfolio and COVID hit us. What we've done over a period of last 1.5 years is we've repositioned the portfolio. We now have a higher weightage of financials in the portfolio. We have a lower weightage of consumer staples as compared to the pre-COVID period as far as this portfolio is concerned. We have increased weights in chemical / manufacturing opportunity within the portfolio. So we've essentially done with a large part of repositioning of the portfolio from a more medium to long term perspective. So you would have witnessed a fair degree of liquidity also getting deployed in the last 6-7 months in this portfolio in pockets and spaces where we believe the opportunity from a more longer term perspective remains very strong. We've essentially focused there and repositioned this portfolio there. The expectation is if the portfolio delivers on the earnings growth that we expect this portfolio to deliver, you will essentially see returns which reflect what happens on the earnings growth, and we see that catch up that happens as far as the underperformance of the past is concerned. On the second question, bro, what was the second question? Compared to the other strategies of ASK. So very clearly, as far as the India Select portfolio is concerned, I think the broader philosophy at ASK remains same, which is high quality, high growth businesses. Where the India Select portfolio differs and where the portfolios differ from each other is more scheme specific attributes. And to that extent, I think given that as compared to an IEP, in an India Select, we can have a larger gambit of ownership structures. I think we are utilizing that lever to see where we can add value, and that is how you would have seen there is a difference between an India Select and / an IEP and the other portfolios. We have a fair degree of representation from professional driven businesses in the portfolio, and that is where particularly in pockets such as financials, where we believe that earnings trajectory or growth trajectory will remain strong. We evaluate each opportunity based on whether it will add merit to the portfolio. That is the function of whether it will accelerate the earnings growth of the portfolio, whether it will reduce risk, do both simultaneously at the same time. So the way the portfolio differs is particularly on the attributes, while the base philosophy continues to remain same. We are more focused, so we have equal weightages for all our schemes. All scheme managers are more focused on their portfolios. The idea first for an India Select is to do the repair work of the lost performance of FY23 and build on to that going forward.
Thanks, Chetan. In context of the auto industry, so combining a few questions there, we see that auto is another sector where a large size of opportunity remains in an economy like India. In recent times, we have had allocation in ancillary companies. So outlook on the overall auto sector, and in line, a question that is presented is why don't we have allocation to something like a Minda Industries?
So autos in general, the view is that there are two things which are happening in the auto space itself globally. So you are essentially seeing a fair degree of transition from ICE to electric vehicle. The fact is this transition will mean that there will be certain winners, there will be certain losers. It's not necessary that the incumbents itself will be clear winners from a more long-term perspective as well. The way we've approached auto space in general is we've been playing this space like you rightly pointed out through the ancillary exposure. We believe that the auto hang provides an opportunity to essentially diversify from a more customer / platform / domestic / export And that is how we've been playing the auto sector itself. The only exposure that we have today in the portfolio is Sona BLW, which is more exposed, or it is on the right side as far as the electrification and the transition is concerned. What we witnessed in FY23 is a combination of few things. One is obviously the fact that it is a more domestic come export driven business, which means that the headwinds as far as the demand on the international business have also played through on that particular name. While in the meantime, structurally, they've continued to add new products. They've continued to increase the size of opportunity which is available to them, and have also increased the order book since the IPO till now. So the order book would have increased from 10,000 crore to closer to 20,000 crore. So the way we were, or we continue to view auto is more from a lens of are we on the right side of the transition that is happening. Having said that, while we'll not touch upon specific names, the fact is something like a Minda or any other auto ancillary name or an OEM name continues to remain on our radar and in our universe list. We monitor these names very closely, as in when we believe that there is an opportunity which is available, we will obviously look at adding that name into the portfolio. Just getting in from what we had discussed in our last quarterly update, there were certain gaps which were there in the portfolio. We've plugged few, or to a large degree, most of them. There are still few gaps that are there. The endeavor is to try and plug those gaps while simultaneously also comparing what is there in the portfolio to the opportunity set that is available. Eventually, the purpose of any addition or deletion from the portfolio is, like I was mentioning, to either enhance the earnings profile, quality of earnings, reduce the risk, or combination of any of these. So that is what drives changes to the portfolio. We are cognizant of the fact that auto still is an underweight compared to the benchmark. There is an opportunity there. We continue to evaluate, and whenever we find a suitable name, we will obviously take action.
Thanks, Chetan. Participants are requested to send in your questions in the Q&A box, and we can take them for Chetan. Chetan, next question is on the lines of the global scenario. So last year, calendar year 2022, we saw a lot of geopolitical activities. In more recent times, the debt ceiling is a most talked about subject. So our views on that aspect and how it may impact the Indian markets.
So very clearly, obviously, debt ceiling itself will have certain degree of ramifications as far as growth/cost of capital is concerned. But our internal view is that we are no experts on this particular subject. It is a subject which is more country specific. What we historical precedent that we have is we've essentially seen the debt ceiling not getting negotiated and some degree of disruption happen in 2011 in the US, with the rating agencies also downgraded, post which immediately we saw certain deal getting brokered and things getting put back into place. Incremental news flow also points towards that around this time around. So our belief is that the necessary steps will be taken there. We are not too worried on what happens there. We are still very much focused on what is within our control, which is essentially identifying businesses which are high quality, high growth, and keeping our focus there. So that is an event, a very important event. We keep a close eye on that, but we clearly are no subject experts on that.
Thanks, Chetan. The next question we have is on the power industry. In overall infrastructure space, India is known to be growing in leaps and bounds as infrastructure is growing. Do we see any promising opportunities in holding into this space in the near future?
So energy as a space itself, be it electricity, power/other energies, that pocket itself is also witnessing some degree of transition. There is obviously a transition which everyone wants to happen, which is pushing more cleaner fuels into the ecosystem, which can be natural gas, which can be hydrogen. Our sense there is a conscious effort to move the world towards more cleaner fuels. That will mean that that sector or pocket itself will have winners and losers. We continue to keep a very close eye on that and to see if we can find opportunities there. As far as utilities and electricity is concerned, in general, the electric utilities are concerned, they essentially have an ROE which is closer to 15-16%. Growth continues to remain in line with the real GDP growth. So while we keep a very close eye on that, we so far have stayed away because in most of the names, our criteria on ROC is where they do not meet, and also on earnings growth, because we look at entities which can deliver earnings growth of upwards of 15 to 20% compounded with fair degree of capital efficiency. These are asset heavy businesses. And hence we've stayed away from these names. We typically look at asset light recurring kind of businesses where earnings growth is higher and stronger with a better quality of capital efficiency. So we are keeping, in a nutshell, a very close eye on the transition that is happening. We are keeping a close eye on the beneficiaries of that value chain. While we might not participate in the more asset heavy part, there is an opportunity which can be exploited more from the value chain itself, for the people who supply the equipment, people who would be doing EPC for them, people who would be supplying consumables for this particular pocket. So we are keeping our eyes there and to evaluating if there are any opportunities which make sense.
Yes, thanks, Chetan. Participants, we request you to put in any questions, if at all. Next question, Chetan. So in the context of allocation towards telecom and technology, we have only certain stocks, or we have limited our allocation to a few stocks in the portfolio. What is the outlook on in the coming few quarters, considering that the geopolitical scenario has affected IT companies in a drastic way?
So on the telecom and technology exposure within the portfolio, we are more overweight towards telecom because what we are eventually seeing, it's become a 2.5, or if you include the government entities, a 3.5 player market. There is a clear sense that while telecom as a service is a centerpiece of a lot of things, mobile has become a centerpiece of a lot of things that we do. There is a clear consolidation that has happened there. Our view is that that consolidation should eventually lead to improvement in capital efficiency for the sector as a whole, while demand continues to inherently remain strong. Where we are underweight is more on the software bit of the exposure within the technology exposure. There our view is earnings growth from a more medium to long term perspective can still be in the range of 8 to 10% in dollar terms. Give and take the margin levers, you would have earnings growth of 10-11%. What has happened at this point of time is, while sometime back there was a view that dollar growth itself had accelerated in the COVID period, there was a view that people will try to squeeze in technology budgets and move towards a more faster digitization within organizations. That meant that there was a belief that dollar growth can accelerate. What has happened in this post-COVID environment, particularly once cost of capital started to move up, is now there is a belief that demand itself will move back down. People will elongate the budgets, and that in turn will mean some degree of repositioning of the IT budgets itself. Our view is that it will still do what it has done historically. It will do a 8 to 10% kind of dollar growth. It will do a 10-11% kind of earnings growth. While from a very near-term point of view, there are obviously worries of how the IT budgets of most of these companies will move, which in turn will mean that there can be some degree of slippages that can happen on delivery for a quarter or two. That will mean earnings will remain volatile. To a large degree, that has also found a cognizance on valuation for the sector as a whole. The valuation itself has moved down. So that provides some degree of limited risk on the downside. While it's only when we start to see the green early signs of revival as far as demand is concerned, we start to see response on the prices itself. So we are keeping a close eye there. We believe it will still be some degree of challenging few quarters for the space.
Yes, thanks, Chetan. That's the last of the questions that we had. So I would request you to summarize with your thoughts, and we can then conclude the session for today.
Sure. So in summary, I'll say, so Prabhu, I probably saw a few questions which were there, which I think we want to address, which is more on underperformance of the portfolio itself, India Select, for some time. I would like to tell everyone that the reason why this portfolio has underperformed is more because of the underperformance which has happened in FY23 that drags down a large degree of performance for the past as well. What has happened in FY23, like we have touched upon quite in our presentations, not only in this quarter, also in last quarter, is that last year was a year while our portfolios delivered the earnings growth they were supposed to deliver. What we saw was that stock prices did not respond to that, and they, on the contrary, moved down. Financials was a big dragger as far as the portfolio performance is concerned. It was a function of largely what happened to Bajaj Twins. While Bajaj Twins delivered on the earnings growth for the fiscal year, what we saw was monies move away to the other names within the financial space itself. That also opened a fair degree of underperformance in the portfolio. What we've witnessed now is a fact that as we look into more medium to long term, after going through this phase of normalization in ROEs, our belief is the focus shifts back to who can deliver growth from a more medium to long term perspective. That is where we believe that the names that we have in the financial space within our portfolio are geared better to deliver faster earnings growth from a more medium to long term perspective. There were certain names which we believed needed a merit into the portfolio. We've increased our weight on the financials within that particular pocket. We've added few names there. So that should help as far as the earnings growth is concerned. A second reason for underperformance was our automotive exposure. So automotive exposure gave us a negative drag. There, like I highlighted, we are exposed to one particular name, which is also in turn exposed more to what is happening globally. While structurally they are on the right side of transition, we've essentially seen order book increase, number of products getting added that have increased. That in turn means that earnings growth acceleration will happen from a more medium to long term perspective, and as that happens, that will find reflection as far as stock prices are concerned. So those were the two primary contributors as far as the drag in FY23 is concerned, which essentially pulled down performance for historical timescales. So we've been through this journey of repositioning this portfolio from the last year or so. Our belief is we've got to a space where we are quite comfortable with the portfolio. Obviously, a portfolio changes is an ongoing exercise. We'll continue to evaluate names which can find merit into the portfolio compared to what we have. There are certain pockets where we still believe there is hope for weight to be increased, which will obviously come at the expense of some other names in the portfolio, because at this point of time, we are nearly completely deployed into the portfolio. So we will continue to evaluate the names that are there in a universe set. The objective clearly is to enhance what I have been highlighting, is to enhance any change should ideally enhance my earnings trajectory of the portfolio, or it should improve the quality of the earnings into the portfolio, or reduce the risk, or any of these three or all three together would be an ideal situation. So the focus clearly remains there. We believe that from a more medium to long term perspective, we are poised for acceleration. FY24 will be a year where we will see normalization in margins driving earnings growth itself. The expectation is volume will start to kick in as well in this year. It was a disappointment last year. It was a function of both volatility in commodity prices, the way demand was expected to play out. We saw two bad patches of monsoon. We saw rains impacting the Kharif season on the later part of the season in October, which impacted post-festive season demand itself. We continue to see a drag of that play out in Q4. The expectation is volumes also start to contribute from a domestic point of view in FY24. On the exports front, that was also a drag in FY23 as the globe was also going through a cycle of destocking. The expectation there is that we start to see early signs of recovery there as restocking begins, probably with a quarter or two lag there. And as the world moves to a more situation of moderate inflation and growth starts to kick, we will start to see the structural benefits of manufacturing getting a larger push in India. You will start to see the structural benefits of acceleration of export itself from here, plus the impact of import substitution that will happen on the manufacturing side. And that in turn will also mean that private capex also starts to come back. Today, what we witnessed is government has been supporting a large degree of capexes. On the private side, we have not seen the kind of capex cycle that we had witnessed in the period of probably 2004 to 2011. That was a period where we saw a very sharp increase in the percentage share of GDP from capital formation itself. Our sense is that will also play out as we move forward. So from a more medium to long-term point of view, we are poised for acceleration. What we are monitoring internally also from a more short-term perspective is on what happens to volumes, purely because of the expectation of monsoons not being as good as the historical long-term averages. So we are keeping a close eye there. If we see monsoons which are more favorable, that will mean that rural, which is right now not contributing to volumes in a very large way, starts to come back in a very large way, because remember, rural has been going through this issue for the last 2 years. And that will mean that as rural balance sheets get repaired, you will see some degree of pent-up demand that plays out from the rural as well, because there we have seen structural impact on the balance sheets in the last 2 years, particularly post the second wave of COVID, and that will be a positive contributor there. As far as the risks are concerned, like we've been highlighting, the risk clearly is more from a volume growth locally, and more from if cost of capital continues to remain higher for a longer period of time globally, that also poses a risk as far as the performance itself is concerned and growth globally itself is concerned. So the way we see the portfolio and earnings growth from here on, our belief is earnings growth will revive in FY24, and we should continue to gain onto that momentum as we move into FY24. So that is all from our end. I would thank everyone for joining us this evening for this call, and we'll obviously speak with you in the next quarter as well. Thank you so much for your time. Thank you. Thank you, Prabhu.
Thanks, Chetan. I thank all participants for giving us the time today. And as is an attempt, we will be connecting on a quarterly basis for these webinars across our strategies. So once again, thank you all, and we hereby conclude the session for today. Good day.
Thank you.